Our next guest says that uncertainty about the ongoing soft landing will keep volatility elevated. Apollo Global Management Chief Economist Torsten Slok joins us now. Powell was pretty careful not to declare victory on the whole soft landing idea. Torsten, are you still not convinced?
Well, I think he was quite balanced, saying on the one hand that things are moving in the right direction. He expects inflation to continue to move in the right direction. But at the same time, he did just simply say that it's just a little bit too early to come to the conclusion that we can already begin to cut rates in March. So from that perspective, he was really telling us rates are going to stay higher for a little while longer, at least in terms of what markets have been expecting before the FOMC meeting.
I guess one of the questions then out of that is it going to be the 3 cuts that the Fed forecast will happen this year, or is it going to be the 5 that the market is forecasting?
Well, that's a very important debate, Sarah, because if you think about it, what would the economy look like if the Fed were to cut 6 times? I mean, would that be an economy that's really weak, with very weak non-farm payrolls, weak consumer spending, weak GDP? Or can they just normalize interest rates and cut rates 6 times without the risk that this might create a big rally in equities and in credit and in risky assets more broadly? So therefore, I think that they are right, that they will cut rates 3 times this year. I think the market has been getting ahead of itself with pricing in many more rate cuts because it will be associated with a much weaker economy if they were to cut as many times as the market currently is pricing.
Well, but that's not necessarily what the market's saying. The market's saying that inflation has been fought and won. And do you not buy the idea that if that's the case, then they have some room to be less restrictive to preserve the soft landing?
True, and if you take their framework, which they have used for decades, namely the Taylor rule, which simply would say that if inflation comes down, nominal rates can also begin to come down, and therefore real rates can stay more steady. Well, then that would certainly suggest that they should begin to cut rates and potentially cut rates a bit more than even what they are saying. The problem with this is that that does not take into account the reality that when they do begin to cut, it does begin to raise the risk of a very significant boom in capital markets activity, in IPO activity, in M&A activity, in issuance in IG and high yield and loans. So if the Fed says green light, you can basically go ahead and take the risk that you want. That will come with the circular effect of creating a boom in housing, in wages, and therefore ultimately maybe even in the labor market. So yes, I understand what you're saying, and I agree that when inflation comes down, nominal rates should also be coming down. But the reason why I think they will proceed cautiously is because of the effects of their actions on risk-taking in financial markets.
Torsten, great chart from you this morning looking at the percentage of household debt that's fixed, almost 90%. You argue that's one reason why the transmission mechanism has been so weak. So are we really at a stage where we're just waiting for the job market to crack? And is that happening?
I mean, it depends on how much weight you want to put on the jobless claims numbers that just came out this morning. And ADP yesterday was also not particularly good. So let's see what we get with non-farm payrolls tomorrow. But if the job market starts cracking and if we do begin to see a more significant slowdown in the labor market, then it will set off a number of chain reactions, not only with housing beginning to slow down, but certainly also we're already seeing the consumer being vulnerable. Highly levered consumers are seeing delinquency rates at high levels. You're also seeing highly levered companies are seeing default rates at high levels. So the vulnerability, and of course, the main issue is in commercial real estate. If people start losing their jobs and therefore office space also takes another hit, then we could begin to see more of these things that we have talked so much about over the last year with the banking sector also potentially being in trouble. So it is a more fragile slowdown that we're seeing here as a result of this. Yes, so far so good. But if the labor market does crack, then that would indeed bring along a number of other problems.